Hello everyone and welcome to the Wells Gibson vlog. As a business, we don't typically provide market commentaries as all they tend to do is add to all the noise that's already out there. However, considering the surreal times we are living in, I thought it would be worthwhile to comment on the past quarter. There is little doubt that the first quarter of this year will go down in investment history as a notable period that investors will remember, alongside Black Monday on October the 19th, 1987, when US markets fell by over 20% in one day. And more recently, we all remember the global financial crisis of 2008, 2009. Perhaps what's more notable is the cause of the most recent falls in the markets around the world as opposed to the magnitude of the fall. In other words, we have seen the instant end of revenue for many companies around the world because of the imposed lockdowns. Thankfully, markets have bounced back in April, so globally developed markets are now down a little over 10% in pound terms so far this year, and high quality short dated bonds have held their value. What is interesting to note is how UK investors have been behaving over this period. In the first instance, there has been a flow of investors moving out of traditional actively managed funds into passive funds that seek to deliver the return of the market as closely as possible. In fact, recent data reveals that UK investors withdrew only £500 million from equity funds as a whole, and this compared to withdrawals of £4 billion in 2016 on account of Brexit uncertainty. And doesn't that feel a distant memory now? If we dig a little deeper, the same data reveals that £2.8 billion was withdrawn from active equity funds and £2.8 billion invested in passive index tracking equity funds by UK investors, most of which occurred in February and March. It's worth noting also that the same data reveals that in March 2020, investors sold more than 3.7 billion of bond assets, and this is probably because lower credit quality bond prices have been severely hit as yields have risen, and therefore many investors have fled to higher quality bonds or cash. It's certainly no surprise that government bonds have fared well, and a similar story has unfolded in the US, but on a far larger scale. So what does the first quarter of this year tell us? Perhaps more than anything else, the insight that we can glean is that risk and return are related. Searching for additional yield on bonds exposes investors to risks that come back to bite them when the markets are scared. And that is why Wells Gibson focuses predominantly on higher quality bonds in our portfolio's defensive assets. We can also see that active fund manager promises are hard to keep, which is why we prefer highly diversified, systematic approaches to the more judgmental approaches of most active managers. Many others seem to agree. At Wells Gibson, we continue to advocate that the following four sensible steps to owning a sensible investment portfolio: build a deeply diversified portfolio, let capital markets do the heavy return lifting, hold on to your returns for dear life, and undertake some basic portfolio maintenance. We don't know what tomorrow might bring in the markets, but at Wells Gibson we are confident in the construction of our portfolios to tackle what might lie ahead. Thank you for watching, and please keep safe.